and good evening. Thanks for bearing with us. I'm just going to run through some very brief housekeeping before we formally open the meeting. The Chair of the South Yorkshire Pensions Authority, to my left, is going to open the meeting, but just a brief bit of housekeeping. I gather that we are not due a fire alarm tonight, so if it goes off, it's genuine, and you'll need to make your way straight out of the hotel and to the right, or to my right here, straight out of the hotel from this way. Toilets, hopefully you found, out to the main area and then to the right. Just to say that tonight's meeting is actually being filmed and will be shown on YouTube. Primarily the cameras will be aimed at the speakers, but if you're camera shy and you don't want to be on the film, you just need to sit nearer the back behind the camera, please, if that's okay. We have to mention that in these days of GDPR, unfortunately. In a break with tradition, we haven't actually provided paper copies of the presentation. We're trying to go green this year a little bit, but electronic copies will be available to be circulated after the meeting. And I think there are a few hard copies around if anybody desperately requires one. We haven't put an awful lot of information on the presentation slides themselves, so hopefully you're not missing too much by not having hard copies. Okay, great. Well then I will hand over to the Chair of the Authority to formally open the meeting.
Good evening, everybody, and thank you for bearing with us in the hope that people come in, and if they do, hopefully they'll come in quietly. I'd like to welcome you all here to Rotherham. As some of you know, I'm Sue Ellis and I am the Chair of the South Yorkshire Pensions Authority. I'm also a councillor here in Rotherham, so it's rather nice to be able to welcome you to Rotherham and my hometown. For those of you who came last year and all the years before, you will have seen some obvious changes and changes of faces in the last 12 months. We have had a substantial amount of change in the Pension Authority, and we've weathered it as well as I think we could possibly have expected to. But I'd like to take this opportunity for all of you who knew Gary Chapman, who was our head of admin, who came year in, year out, giving you the news of how we'd progressed. He retired after 40 years of working for the authority, so I think he deserves a really happy and long retirement after all that time. You also know from Gary, those of you who've sat here, how he told us it all straight, and he told this meeting it straight when we had problems, and he told the councillors, and for that very forthright speaking, he is and will be really missed. The other people that we've said goodbye to this year that have served us really well is our investment team. And you'll hear later how well they served us in the returns on our investment that they managed to achieve. They matched all the London whiz kids and the financial houses down in London, and proved in South Yorkshire we have great skills and ability if people just give the opportunity to those. We haven't lost them too far. They've gone off to Leeds to Border to Coast, which is the other major change this year, and they're serving us there, serving BCPP and serving us. That's the Border to Coast pool that we're a member of. And as we said goodbye to those long-standing members, we've also said hello to George and Jason. George Graham, who is our new fund director and came to us after we've had 18 months of a temporary fund director. So I think we all feel great relief when he came that we could get into looking forward and making good solid plans for the future. And I'd also like to welcome Jason Maley, who's taken over from Gary. Hard act to follow, but I've got to say that they've both made, you know, a really good, impressive start, and so all bodes well in the future. And with that, really, I'd like to hand over to George, so be kind to him. Oh, it's Jason first, sorry. So we'll hand over to Jason, and he can tell you where we're at, and hopefully it will be some good news as well as maybe some honest feedback.
Thank you, Sue. So just before we start with the presentation, you've probably gathered that I'm not from South Yorkshire, from my accent. I've been working down in Surrey for the last 20 or so years. I've just moved up from London. But actually, this isn't the first time that I've been to this hotel. In the early 90s, when I was just a college boy, I was at college with a flatmate who was a Rotherham United fan and from just down the road in Broome Valley. And every time he used to drag me out to come and watch Rotherham, he would insist that we go to this hotel afterwards for drinks because that's where all the footballers used to hang out. So whether they still do or not, I don't know. But it was a bit strange coming back here after all that time. So today I'm just going to just give you a run through of my first impressions of how the administration service is performing here at South Yorkshire. On the whole, extremely well. I think it's also fair to focus on what I think as an organisation we can do better and what my challenge is going to be over the next couple of years. A little bit of reflection on the small number of things that have changed in the local government pension scheme over the last 12 months or so, and also what might be coming up in future. Pensions is hitting the headlines quite frequently these days, actually, so a little bit about that. And then finally, to focus on what we're doing at South Yorkshire Pensions Authority to move us into or even more forward into the digital age, and our focus on online support. Okay. So first of all, then, just have a look at our performance over the last 2 or 3 years. As Sue mentioned, Gary, my predecessor, would have stood up in front of you for the last 3 or 4 years and talked to you very honestly about the real difficulties we had as an administration service that were caused primarily by the change of administration system, change of IT system. And actually, I'm fortunate to say that I've joined at the real tail end of all of those problems. Gary and his team have done all the hard work, and I've just stepped in at the last minute and reaping the benefits, really. So looking at our performance for the last 3 years, there's been a gradual increase back in 2016-17. If we looked at all of our administration cases, we're only about 70% of our targets. Last year, up to 82%, and then this year so far, around about 83 overall, a bit higher for what we call priority cases, which are predominantly retirements and dealing with benefits when people have died. What we've also done extremely well this year is to be able to produce our annual statements to our active members and to our deferred members by the statutory deadline of the 31st of August. So in 99% of cases, we were able to meet that deadline, which is a significant improvement on what we've done in the past, and really is a compliment to all of the hard work that's been put in over the last 3 or 4 years from Gary and the team that I've inherited. So we're on an incremental increase. I think that was the phrase that Gary probably used at last year's presentation, but that's where we are. Things are definitely improving, getting near to where we were perhaps 5 or 6 years ago. But there are some things that we still need to focus on. I'm certainly not complacent coming into a new role. So what I wanted to mention there was first of all, we have quite a strict set of targets by which we measure ourselves for the completion of various types of casework. We aim to get all of our retirements completed within 5 working days, any processing of dealing with deceased members, 4 days, and even fairly routine pieces of work like dealing with transfers in and transfers out of the scheme. We've got quite tight deadlines there. Now those those target times are a lot tighter than what I've seen elsewhere in my local government career, which is great. We set ourselves very challenging targets, but I think we also need to be realistic about what we can achieve. Like all public sector bodies, we are faced with diminishing resources, and we need to be mindful about our expectations, really. So one of the things that we're asking our scheme members, and you may well be surveyed, and I'm sorry if you are, you're probably fed up with survey monkeys and everything else, but it's important for us to capture that feedback, really, and to understand what's important to you as scheme members. So we will be asking you about, are we actually focusing on the right areas? So if you take, for example, a transfer out of the scheme, we actually have, under the overriding legislation, we have 3 months to deal with a transfer out, and our target time is 5 days. Now, if we can meet that in all cases, then great, but I just wonder whether sometimes our focus gets moved slightly into directions where it doesn't need to. So we need to think about how we can properly manage our resources going forward to make sure that we provide the best service. The other question I've put up there is are we actually asking the right questions here? So if we pick the example of processing retirement benefits, we can work very hard to achieve a timescale of 5 days and make sure we process everything that we can within 5 days. But what we really need to be looking at is what's the entire customer experience. So if we're waiting for a month after the person's retired before we get the information from the person's employer, for example, that's not a complete end-to-end process for our customers. It's all right for us to complete our work within 5 days, but what we really need to be looking at is actually what's the customer's experience, what they're expecting from us. And that's a piece of work that we'll be doing over the next 12 months to understand a bit more about how we best serve our customers through the entire retirement process. And the same sorts of work can be done across all of our areas. Okay. So we have a selection of scheme members here. Some of you are active members, some of you are deferred, some of you have retired. And the reason I've put this particular slide up is that over the last 3 or 4 years, since the scheme changed from final salary scheme to a career average scheme, we've had a real issue with the subject of aggregations. Aggregations really is the work that we need to carry out when somebody either moves from one job to another, or they have a series of jobs. They might be working in more than one job at the same time concurrently, and then leave one employment and move on to another one. And before the change in the scheme back in 2014, dealing with those changes from the pensions perspective was actually extremely straightforward. You were just moving people's service from one place to the next, and it was fairly easy to manage from an admin point of view. Since 2014, however accidentally, the government really complicated the handling of people who have more than one employment. And consequently, it's taken us an awful long time to develop the software that would enable us to handle. There are about 15 different types of scenario of case that we've got to deal with when we're handling aggregations. And what we've ended up with is around about 7,500, 8,000 pieces of work that we need to complete as a result of the complications caused by this change. Now that's how we got into this position, and we are in this position. Fortunately, over the last 12 months, we have been working on a very complex piece of software that would automate much of that process for us. That software went live over the summer, and from the 1st of October, as you can see, we established a dedicated project team of our experienced officers who are working full-time on dealing with this backlog of aggregation work. We've set ourselves a completion date of the 31st of March, so a six-month project to handle something like 7,500, 8,000 cases. Sounds daunting, but so far so good. We've only been doing it for a couple of weeks, but we're making very good progress against that, and in fact have completed over 1,000 of those cases already. So if you're one of those people, and some of you may be here, that's been waiting to hear about your different pension pots, it's probably tied up in this work here. And when it's out of the way, will be in a much stronger position going forward. The point about this is that it has a real knock-on impact on the other work that we do. So if somebody's coming up to retirement and they've still got 3 or 4 records when actually they only need 1, then that causes complications and difficulties for scheme members. So it's an important area that we've invested heavily in and will hopefully be resolved, and we'll be reporting regularly to authority members on our progress against that. Okay. So what's changed in the LGPS in the last 12 months since Gary spoke to you? What I've said there is actually not very much, which is great news, not just for us as administrators, but it's also good news for members of the scheme, because invariably when the scheme changes, it's to the detriment of our members. So the fact that there hasn't really been any significant change in the last 12 months is a positive thing. And I think we're thankful for that period of stability, and I hope that remains the case. The main change actually that has happened was a change in May this year, and it only affects deferred members of the scheme, so people who've left the scheme before retirement and have a preserved or a deferred benefit with us. And that was an extension of provision to allow people to claim their pension from the age of 55 onwards. So you might be aware that that facility was brought into the scheme in 2014 for active members and for people that left the scheme after 2014. But it wasn't previously introduced for people that had already left before April 2014. So the change in May was to say, actually, we acknowledge that all those people that left the scheme before 2014 ought to have this same provision to be able to choose to take their pension early. And obviously, you can't just choose to take pension early without there being any impact. And I've said there that reductions will be applied to the pension. And I just want to focus for a minute on this point about reductions to people's benefits, that when people retire early or claim their pension early, because people often perceive it to be a penalty that's applied somehow. And actually, what we're really doing is we're just recognising the fact that the earlier that you retire voluntarily, theoretically, the longer your pension will be paid for. So let's imagine that life expectancy was 80. It's higher than that at the moment. But let's assume for simplicity it's age 80. If you take your pension at 65, the assumption is, all things being equal, that you would receive your pension for 15 years. If you take that pension at 55, you're going to be getting the pension for 25 years. So what we have to do by applying the reductions is actually just reflect that longer period that the pension is going to be in payment for. We're not applying any penalties. We're just stretching out the amount that we're paying out of the pension fund. So it's an important distinction, really. If you're an active member of the scheme, there were a couple of minor changes that happened during the year that I'll just briefly mention. One of those was the fact that if you are paying additional voluntary contributions, which is an arrangement whereby you pay some extra money to an external provider to buy you a separate pension pot. There were some flexibilities introduced around what you can do with that money when you retire. Not particularly significant. But the top one there was just, I guess, a correction to the legislation around people that aren't married but have a cohabiting partner. Previously, prior to 2014, you actually had to specifically nominate your cohabiting partner to receive a pension on your death. That changed in 2014 to mean that you didn't have to make a nomination, that you would still potentially, or your partner would still potentially be eligible for a pension, even if you hadn't completed a piece of paper. What changed this year was that legislation was made retrospective to cover people that retired in the past. So fairly small change, but one that has opened up some past cases. So what might be coming then in terms of changes to the LGPS? Again, I hope not too much. There is this thing called the cost sharing mechanism, which will be coming into play, certainly for us as administrators, over the course of the next few months. And what that means is, if you recall, a few years ago when Lord Hutton produced his long-awaited report on public sector pensions reform, and all of the public sector schemes were changed at that time, what they spoke about a lot was the long-term affordability of schemes like the local government pension scheme. And what happened at that time was that the government introduced a cost cap mechanism to make sure that the cost of the LGPS, the cost of providing benefits to all of you members in the LGPS, the cost could be sustainable over the long term. So in reality, what that means is that the cost of providing benefits in the LGPS in future was set overall at 19.5% of pay. So that's at a national level. It's not an individual level, just at a national level overall for the whole scheme, disregarding what salaries people earn and so forth. The actual overall assessment was 19.5% of pay. So employees pay a third of that and employers pay 2/3 of that. What this mechanism said is that, well, that's what we think the scheme's worth, that's what it costs going forward. But if the experience in a few years' time is that it's proving to be more expensive than that, or cheaper, then what will happen is that this cost-sharing mechanism will come into play, and either members' benefits will go up if it turns out the cost of the scheme was cheaper, although all their contributions will go up if it turns out the cost of the scheme overall was more expensive. So round about now is the first time that for our scheme we're actually making this assessment at a national level. Now, we don't know what the outcome of that will be. My best guess at the moment is that the benefits will stay the same, and that's certainly the outcome that I guess we're hoping for. But that work is being undertaken at the moment, and you might see a slightly different impact with some of the other public sector pension schemes, like the teachers' pension scheme, for example. They work on a different way. They're not funded like our scheme. They don't have specific pension funds. They work on a pay-as-you-go basis out of Treasury coffers. But there might be some changes coming out of this cost-sharing mechanism and this cost cap for public sector schemes. So you might see a bit more about that in the news over the next few months. Okay. Not specifically about the LGPS, but the other thing that is making the news at the moment, and in anticipation of the budget coming up in a week or so, is the possibility that the Chancellor is going to look at tax relief for all pension schemes, not just the LGPS. We don't know if he will or not. But I just thought I'd reflect on why it is that he might be looking at that. So this table here, we've given some examples on the left-hand side there of somebody's annual salary. Let's assume that they've got one source of income and they pay tax in the normal way. They've got a standard tax code. That's their annual salary, their annual gross salary there on the left-hand side. And on the right-hand side is the actual net cost in their pocket of providing £1,000, of contributing £1,000 towards their pension. Now, if you earn £10,000 a year, you don't pay any income tax if you've got no other income. So therefore, you don't get any tax relief. So the actual net cost to you is £1,000. There's no benefit there. If you earn £25,000 a year, you're a 20% taxpayer. So you've got a 20% saving. So it costs you £800 in your actual pay packet. If you're a higher earner, and you're a 40% taxpayer, it actually costs you £600 in your pay packet for £1,000 of pension contribution. So there's an inequality there that the Chancellor may or may not address. It's not really the Conservative way, but who knows? I think he's got to look at his options. One of the options was introducing a 25% tax relief band across the board. Now that comes with huge complications about administration, so I don't know how popular that will be. But it is also worth bearing in mind that we recognise this inequality, but the local government pension scheme already actually does have different contribution rates for different levels of earners. So we've already reflected that inequality in a sense. So the Chancellor will need to consider those sorts of questions if he's looking at tax relief as a whole across pension schemes. So you can see that somebody earning up to 14,000 only pays 5.5%, whereas somebody earning 63,000 pays 9.9%. So there's already a difference in our scheme built into that. But just something to bear in mind, because you probably will hear more about this issue about tax relief and pension schemes more widely. Okay. Bit of good news, I hope, for those of you, this was just published yesterday, those of you receiving pensions, but also current members. Next year, pensions, local government pensions will be going up by CPI, 2.4%. That also applies to current members, and is the revaluation of your pension pot at the end of each year is going to go up by 2.4%, which is probably a lot higher than pay awards at the moment if you're a current member. So there's a bit of an increase to your pension from that. The same applies to people who are deferred pensioners as well. Okay. So, as a pensions authority, we need to be very mindful about the costs of our administration service and how we can provide the best service for the cheapest or the best value, I guess, in a sense. So one of the ways in which we can do this is moving more of our work online and communicating with our scheme members much more online. Particularly here, I'm focusing on current scheme members, not those of you who've already retired, and not necessarily really those of you who've got deferred pensions either. But what we've done is we've invested in a new online portal. So if any of you use our online portal at the moment, you'll probably say it's a little bit clunky, it's a bit outdated, doesn't do all the things that we'd like it to do. So we've had to invest a bit of money up front in a Wizzier online offering, due to go live early next year. A fair bit of work to do in terms of development still, but what we hope to do is communicate with our scheme members and allow you to do much more online. So thinking a couple of years down the line, and it is a couple of years down the line, I've recently moved up to South Yorkshire, as I mentioned, and I was applying for a mortgage. Now, my entire mortgage application process was handled online. So if you can do that for a mortgage, why can't you do it for a pension? Is the obvious question. So longer term, they're the sorts of things that we're working towards. But it's going to take a little while to develop that. Worth mentioning though that you can already do a fair bit of stuff online as well. So this is our existing pensions portal called My Pension. If you're an active member, if you're a current member of the scheme, there's a number of things you can already do, and some of you do that, but it's just worth a timely reminder. The picture in the left-hand corner keeps catching my eye. It looks just like Meghan Markle, doesn't it? Have you noticed that? Or is it just me? I don't think that's Prince Harry down there. So at the moment, you can check your membership record online. You can run through as many retirement projections as you want to, with different leaving dates, different assumptions about your future pay, all those kind of things. You can update your beneficiaries online, and you can also view the annual statements that we send out to you. And in fact, from next year, if you're a current member of the scheme, we will be putting all of our statements online. We won't be posting out hard copies unless anybody specifically requires one for a particular purpose. But we're moving towards this online offering. We hope everybody will register for that. If you've already retired, we don't want to leave you out of this. We will, of course, continue to send you pay slips to your home address if you want to. But there are a number of things that you can do online. You can update your address. You can view your pay slips. You can look at your Pay60 information. And you can also check about your beneficiaries as well. So that sort of functionality exists online already, but we do need to do much more work in that area. Okay. I've included this just because there's some, on the right-hand side, the references to our website and the various links. These will all be circulated after today's presentation. And on the left-hand side there, just to alert you to the fact that at some point during November, I hope, we will be moving from our current offices in Regent Street in Barnsley to our 8th floor of Gateway Plaza, so one of the much more modern open plan offices higher up the street in Barnsley, about 5 minutes walk away. All our posts will be redirected, of course, and we will communicate this when we've got a firm moving date. But please don't turn up at Regent Street after around about the 18th or 19th of November, because you might not find us there. Okay. So we did ask for any questions to be submitted to us in advance that anybody wanted to raise. So there was just 3 that I'm going to quickly run through, and then I'm going to open it up to the floor for any questions on anything I've said so far. So these are specific questions that people have raised about their benefits. The first one was, can I access my pension if I've been made redundant at the age of 59? Well, still within the scheme. Who knows what might happen in the future, but still within the scheme, you have an automatic entitlement to an unreduced pension if you are made redundant from your post in local government over the age of 55. Okay, so it's not about being able to access your pension. You have a statutory right to receive that pension. If your employer makes you redundant, whether it's voluntary or compulsory, you have a right to receive an unreduced pension from the scheme over the age of 55. Now, there are cost implications for your employer in that, but it's not a decision that they have any flexibility over. If you are redundant, then you are entitled to that pension over the age of 55. It's a simple matter of law. Okay. The second one is one that we often get asked, which is about, can you make extra contributions to your pension pot, whether that's a lump sum or monthly contributions, and do we still get tax relief? Yes, absolutely. Nothing's really changed in that sense. Within our scheme, there are 2 main ways of paying extra contributions if you're a current member. One is that you can, within the scheme itself, you can buy extra blocks of pension, either as a lump sum or over a period of time with a minimum of a year's contribution. So the beauty of that, I guess, is that you know exactly up front how much extra pension you're buying. So particularly for those of you who might not have joined the pension scheme early in your careers, or you've had career breaks, or all sorts of reasons why you might want to build up your pension, there are options to pay extra contributions, and you do get tax relief in exactly the same way as your basic contribution on that. Your employer doesn't subsidise it, of course. You have to pay for the benefit yourself, but there is that facility. And there's a more flexible option, which is the additional voluntary contributions I was referring to earlier, AVCs, where you basically build up a separate pension pot with an investment house, and you have some decisions to make about where you invest that money. That's a little bit more flexible, but obviously a bit more risk potentially involved in that. But it is an option that's available to you. Okay. And finally, how soon can I retire? Does it depend on how many years I've served or how many years I've got in my pension pot? So I was mentioning earlier that within the scheme now, anybody can retire voluntarily from age 55. Now, the normal pension age for the scheme is now the same as your state pension age. So in my case, it's 67. So if I want completely unreduced benefits, I'll have to wait until I'm 67. But I could actually choose to retire at 55, and I would have an adjustment of that extra 12 years worth of pension if I chose to retire. So you don't need your employer's consent. You know, if you've had enough at work and you just walk out the door one day, and at 55 you can claim your pension if you want to do so. It will be on a reduced basis. There used to be all sorts of rules about how much service you needed to have in the scheme and so forth, but since we moved schemes, that doesn't really come into play. Okay, I think that was all I had to say, but I'm very happy to take any questions on anything that I've covered or anything else about the administration aspects of the scheme. And my colleagues here have got microphones just to capture it for the cameras.
Good evening, everyone. My name is Carlos Jesus Fernandez Cabrera. I am from Chile. I work for Doncaster Metropolitan Bureau Council from the 14th of August 1991 until my retirement when I was 65 on the 14th of February 2010. I worked first in children and family, and then I moved on to mental health. I wasn't transferred for personal reasons. And in 1997, one of the advisors from the company came to see me at my home because at the time, in 1997, there was a movement to try to get some money out of your fund and invest it so you could get a better pension. Now, for several years, I completely forgot about that investment. And in 2015, I started to ask questions, what happened to that money? Because it was never in my money when I retired in 2010. There was always evasive answers.
Okay.
Now this year, I asked again, and they sent me a statement saying what happened with the £1,000. The statement got lost because I had to go to Chile for, like I said, for personal reason that I am not prepared to disclose here. I am prepared to disclose them in private. And for some reason or another, everyone wasn't giving me a right answer. I went to a meeting in August at the 18 Regent Street, and there were still evasive answers to my questions.
Right.
And I put the question in the internet.
Okay. So
I must say that I find it really hard that they put every aspect of the pensions in the internet. Not everyone is good with computers. Especially when you are old, you tend to forget your password, you tend to forget even your number to go to get the money from the bank.
Okay.
So it's very easy to forget it.
Okay.
And it happened even several times to me, because when you are under pressure or you got any problem in your life, you tend to forget the password.
All right.
So that's my question.
Okay. All right. So there's actually a few questions there I think that I can probably address. The first one that you asked at the end there was about moving things online. Really important to stress that what we're interested in doing is being able to communicate with all of our scheme members, and we're certainly not going to force people to make transactions online. That's not what we're trying to do. What we're trying to do is make the most efficient use of the resources we've got available. So if people don't want to communicate with us online, it's not necessary to do so. You'll appreciate I can't answer your specific query now. My colleagues can take your details, but there is a general point there around if you've lost track of your pension somehow, whether it was in the LGPS or outside, there are various, and in fact the government runs a pension tracing service that allows you to trace lost pensions. They're also talking about, what they've been talking about for some time, a national pensions dashboard whereby you would just simply enter your details and all of your pensions over the whole of your career would be available online. It's something that the Chancellor first announced, the then Chancellor, George Osborne, then first announced back in 2016. It was due to be live in about 6 months, but it's not going to happen just yet. But that's the aim. So there are some tracing services available. I can't answer what happens. There were during the 80s particularly a period when people were encouraged to opt out of the local government pension scheme, and that was later addressed. So it may be that your rights were transferred out to another scheme and you've lost touch with them. It's difficult to say without looking at your case. But my colleagues can take the specifics of your case away if you speak to us afterwards. Okay, thanks. Any more questions on anything I've spoken about?
I just wanted to ask if the early retirement age of 55 is likely to be changed, bearing in mind that we're now having to work a lot longer before we're entitled to a state pension.
Although on that point though, or not directly on that point, but I was just reading some research yesterday that said that the longer you work, the greater your life expectancy is. So it's not all bad. But To answer your question, there are no specific plans at the moment to change the earliest retirement date from 55, but my guess is that within the next couple of years it will probably change to 57. It's just my informal opinion, half-informed opinion, but I'm pretty sure that it's coming at some point over the next couple of years, yeah. But there have been no announcements about that yet, but it wouldn't surprise me to see that happening. Yeah. There's one here coming, yeah.
I hope it's not too specific. I joined in South Yorkshire Pensions December 2014,
Right.
and I wanted to bring in a pension pot from London Pension Fund, and at that time it was too complicated. And I ran out of time for having my year.
Yeah.
Can I still try and transfer
Well,
it?
yeah, if it goes back to this point I was talking about aggregation. So you're exactly one of those people. So if the reason for the delay was because there were some issues around us calculating your case at that time, then absolutely we'll extend the deadline. For people who've already been given the opportunity and chose not to do it, that's a slightly different thing. So I can't comment on your individual case, but again, you can take it to, we can speak to our colleagues afterwards, can take the details. But there are some people that have been waiting for some time for this, and you're right that the deadline, the standard deadline is you have 12 months from joining the scheme to bring pensions in. But for a number of reasons, people haven't necessarily been able to do that. So where it's outside of members' control, we will obviously make exceptions for that. Yeah. Thanks. Any more? Okay, great. All right, well, thank you. Thank you for your time. Thanks.
Right. Good evening. My name's George Graham. I'm the fund director. So, as well as being responsible for the overall running of the authority services and the fund, I'm going to talk tonight about investments, investment returns, and all the sexy stuff about what we do with all the money you contribute to the scheme and how we look after your savings. I started in February, so slightly before Jason, and I was quite surprised to get the job, given that I was coming from Lancashire. So I may live to regret after tonight having managed to cross the Pennines. So I'm going to talk a bit about where we put the fund's money, how that money's been doing with what we've done with it, a bit about the P word that Sue talked about, pooling. A bit of a look to the future, because there is quite a lot going on, and the fund is in a different place to the place it's been for the last 30 years that the Pensions Authority's existed. So we need to refocus a bit and look at different things, and then answer some of the questions that you sent in. And as with Jason, there'll be an opportunity to have some more questions from the floor. Okay, so the inside circle here is where our money was allocated at the end of 2016-17, and the outside circle is where it was allocated at the end of 2017-18. Now, I'm just going to move over here. Sorry, Sue, you might get blocked out. The key difference is this blue segment of the circle. That's what we invest in stocks and shares in companies, equities. That is significantly smaller than it was previously. Now, the reason we invest in equities is that they're what's called growth assets. They're where the increase in the capital value of the pension fund comes from, and the fund's gone up since the authority was formed in 1988 from about 490 million to 8 billion. So we have reached a place where that deficit that John Hattersley will have talked to you about at these meetings year on year on year, according to the actuary, it's just about gone. It's either gone or just about gone. about fully funded as a pension fund. That means we don't need to focus so much on capital growth. We can take a bit less risk. Equities are the most risky part of our investment portfolio. So we can take a bit less risk. So that's why that bit of the circle's reduced in size. The orangey bit, which is bonds, that's government bonds and bonds issued by companies as a way of borrowing money rather than borrowing from banks. That's about the same. Those are broadly what are called defensive assets. So they sit there and they just throw off the income they throw off, and eventually we get the money back. We've increased our exposure to property because that's a good income generating asset, and the change in the funding level of the fund means what we need to be looking for is income. We need to be able to harvest income more. And the bit that's grown most significantly is what's called alternatives. Now, alternatives are a wide range of different sorts of investment, but there are three broad categories that we invest in. The first is what's called private equity. Now, there are different sorts of private equity. The most widely known one is venture capital. But we don't actually invest particularly in venture capital. We invest in management buyouts of companies and company takeovers and things like that. The second category is infrastructure. So airports, renewable energy generation. We've got significant investments in renewable energy generation within our infrastructure portfolio. Trains, power distribution, all those sorts of things that keep a society running, which can provide an income stream one way or another. And we also, within that, have an investment in social housing through an investment fund. Yeah. And the other bit that's grown is cash. We're holding more cash than we used to do. Now, that normally we wouldn't do that, but our investment team quite rightly took the view that the equity market was overvalued, and at some point the equity market was going to fall. So they didn't want to lose money. So they took money out of the equity market and put it somewhere safe in various deposits while we try and deploy it into these alternative assets. Those take much longer to build up. You don't just buy shares in the way that you can. So if you're buying infrastructure, you don't have someone sitting at a screen saying, I'll have 5 of those gas distribution networks or whatever. You have to go and make an investment in a fund in a much more structured and long-term way. So that money's waiting to go into alternatives, and we've got commitments over the next 5 to 7 years of about £1 billion, but that's funded by money coming back from other things largely. Okay, so how has the fund done? I like this graph. This is my favourite graph. The colours are also slightly deliberately chosen. It so happens that this year is the 30th anniversary of the Pensions Authority being created. That's, as you look at it, that's the right-hand set of bars. Over that 30 years, your pension fund has returned 8.8% per year on average. Now, I wish my savings over the last 30 years had returned 8.8% a year on average. I know they haven't. That's absolutely nothing to do with me, and all to do with the fact that the authority has had a very hard-working in-house investment team who focused on a relatively low risk but very constant investment strategy over that time. South Yorkshire as a pension fund hasn't chopped and changed what it's doing. It's kept focused on doing what needs to be done, and that's made a real difference to the funding level. And we've done better over almost every period than the average local government pension fund. That's nicely satisfying, but actually not really relevant, because our job is to pay your pensions, not to pay the pensions of people in Greater Manchester, the Greater Manchester Fund. So all we need to do is make sure that we can meet the South Yorkshire Fund's liabilities. But it's always nice to beat the Mancunians. Right. So, as I said, sustained performance. We're now estimated to be around fully funded, but, you know, you'll have noticed in the last week or so the market's taken a downturn. Well, things vary from day to day. Theoretically, they vary from minute to minute, but we don't monitor them that closely. Okay. Having made that really important progress in achieving an almost something that's around fully funded, we don't want to take a step backwards. So if the market takes a big tumble, we want to try and insulate ourselves against that. So what we've done, again, I can't claim credit for this. This is something that was initiated before I started. What we've done is take out a sort of insurance policy. Now, the way we do that is we say, we don't want to lose money if the market drops by between 5 and 30% in our case, okay? So we won't lose money if the market drops by between 5 and 30%. If it drops by 4.5%, we'll lose 4.5%. If it drops by more than 30%, we'll lose the bit above 30%. Likelihood of a drop of more than 30% is relatively small. Now, to pay for that, what we say is, well, we won't have any gains if the market goes up by more than 14.25%. So to pay for that protection against losses, we've given up some potential profits. Now, given that we've brought our deficit down by making returns of 8.8% a year, year on year for 30 years, 14.25%, you know, giving up profits above 14.25%, while not great, is worth it for the downside protection. And given that the actuary says we only need to make about 4.25% a year at the moment, you know, logic says we can afford that, to give up that potential upside. And that strategy, which is executed through financial derivatives of various sorts, which are far too complicated for now, is working, and it's protecting the value of the fund, which is what it's meant to do. So, as I said, we're looking to invest the money we've released from equities into property and alternative investments such as infrastructure, and I'll talk a bit more about some of that in answering the questions. Okay, so the P word, pooling. Sue talked about Border to Coast and the fact that 6 of our team have moved over to Border to Coast. Now, they're not just now running our money, they're also running money for East Riding and Teesside, who also transferred some internal investment staff to Border to Coast. But they're also now running money for Cumbria, or will be running money for Cumbria shortly when their money transfers in, who've decided that the in-house product that that team is offering is better than the product they were buying from an external investment manager. So that's actually a big vote of confidence in the team. As of today, 52-ish% of the fund is being managed by Border to Coast directly. There's another 35-ish% where they're effectively doing all the work, but we have to execute the transactions of various sorts because of various regulatory issues. So they're continuing to build out what they do, but the process of us transferring our assets into their structures will go on until at least 2020 and probably beyond, because some of the things won't transfer. They'll finish their natural investment cycle, and then we'll invest the cash in Border to Coast. And Sue's too modest to mention it, but she's been elected by the shareholders of Border to Coast as a non-executive director of the company. Now, that is very important for us as a fund. That gives us and our way of thinking an important influence and a voice at that table, which will be important as we move forward. So, looking to the future, full funding means that the valuation of the fund, which takes place next year and which sets contribution rates for employers, is taking place in quite a different context. So we need to think about things in a different way. The investment strategy previously was, well, we've got to take risk to fill in this hole, this deficit that we've got that we need to think about. Well, now there's an element of the strategy which is, under no circumstances will you take risks and lose money. So there's a balance we've got to see. So we'll need to focus more on generating income and matching cash flow, so that when the next person retires, we know we've got the money in the bank to pay their lump sum, and so on, and have the cash to pay their pension. There'll be less emphasis on the growth that comes from our equity investments, but there will still be some emphasis. We can't lose that, because new people are joining the fund all the time, and we need to grow the assets of the fund to pay their pensions, some of which won't become due for 40 years, another 40, 50 years. We are a very long-term institution. Someone who's joining a council as an apprentice today, 16, 17, I would be surprised if their retirement age is 67. Unfortunately, it might be closer, it might be beyond 70. So we need to think about things in that context. So we still need that growth. Okay, so to work that through, starting next summer when the actuary's working away on setting those contribution rates, we'll be working away on really getting inside what our new investment strategy should be. That will set out how much we should have in each asset class, why we invest in each type of asset, what we want to achieve in terms of some of the more impact side of what we do with our investments, because that's important to us. What's called responsible investment, or environmental, social and governance issues, if you like, those are very important to the authority and this pension fund. So we need to factor all that into what we do. But we also need to think about how we influence Border to Coast, who will be our principal investment manager, who will in effect be responsible for implementing our strategy. We need to work out how they can deliver that for us, and how we and the other 11 funds involved come to a consensus about what they should be delivering for us. Okay, so moving on to the questions. So first one, how do we ensure probity? Well, we are a local authority. We're not council, but we're a local authority. So the same rules that apply to the officers and councillors in your local council apply to us in exactly the same way. We have a monitoring officer and a chief finance officer who will tell the members if they are proposing to make a decision that is in some way unlawful. And they have the power to stop members making those decisions if necessary. They'll also stop me making any decisions that are potentially unlawful for the same reasons. So that framework that exists in English local government applies to us in the same way as it applies to your local council. Now, when I worked for a county council, one of the things I did was get that council credit rated by an organisation called Moody's. So you'll hear about people saying this is a AAA rated institution, and there was a big fuss when the UK government lost its AAA rating. Well, when you go through that process, the credit rating agency will comment on the strength of the regulatory framework and the framework of ethics and conduct in the sector they're looking at. And the agencies give British local government in general the highest possible rating for that sort of thing. So that's essentially how we deal with that. Now, there were several questions, all phrased differently, that essentially focused on the same issue, which was about climate change and the level of carbon emissions that companies in which we invest make. And the core of all those questions was, well, why don't you just not invest in oil and gas companies and take the money you've got in oil and gas companies out of those companies? We could do that. Perfectly possible. Well, it was perfectly possible until we transferred all the cash to Border to Coast. Now it's more complicated, but we'll address the situation initially in terms of, we control our own money, therefore we can do it. So, yeah, we could do that. But if I take £100 million out of Shell or BP, that will have absolutely no effect on Shell and BP in terms of their impact on the environment. They won't notice it. Someone will buy those shares. It's absolutely no impact. What the authority prefers to do, and it's been its strategy up to now, we're reviewing the investment strategy, so that may change. It prefers to engage with companies and persuade them to do things more responsibly. Shell and BP are both actually quite good examples. They are taking steps, not as quickly as the authority would like, and not as quickly as many shareholders would like, and I'm sure not as quickly as many people in the audience would like, to adapt their businesses to a low carbon future. But they are moving, and they're moving as a result of the collective of shareholders and their influence on them. Now, let me take an example of this. One of the major things that holds back electric vehicles becoming the way that we provide the private car is that there isn't a sufficient network of charging points. Now, a sufficient network of charging points will only really become available when it's as easy to charge your car as it is to buy petrol. BP are committed to providing charging points in all their petrol stations. So over time, eventually turning their petrol stations into charging stations. Now, that will be, that happens. That's possibly the tipping point in terms of electric vehicles and the viability of electric vehicles. So, if we don't invest in BP, we're not part of that. You know, I accept it's a perfectly valid argument that you shouldn't invest in things that pollute. I have no problem with that, but that's the nuance and the debate that we have to have. You know, we don't try and influence companies like BP. They won't do that. And it's the influence of investors have had that makes companies do things like that. So we don't disinvest, we engage. That will not move things as fast as many people would want. I entirely accept that. And that is a debate the authority will continue to have about whether it disinvests or engages. Now, that's all very simple when, as we were doing up to July, we run our own money. Now we don't run our own money, and we are simply one of 12. And the 12 funds within Border to Coast are probably on a spectrum in relation to what are called responsible investment issues. We're probably at one end of the spectrum, and Bedfordshire, I think, would it be fair to say, Sue, Bedfordshire, are probably at the other end of the spectrum. Surrey, interestingly, particularly on environmental issues, who are the other southern authority in the pool, are probably closer to us than some of the northern authorities. So what we've got to do is influence others to move in our direction, because Border to Coast have to provide products. They can't provide a product solely for us. They have to provide a product that's commercially viable, that everybody will invest in. Now, opportune time, so we're going to begin, and we have already begun discussions about how we can reduce the carbon exposures of the equity portfolios that they're running. Now, there are different ways you can do that. One way is to actively engage with companies and say, look, we need you to reduce your carbon exposures, and actually work at that and set some targets to say that the carbon emissions from the portfolio will reduce over time by X, Y, or Z, and influence companies to achieve that. The other way of doing it is to change the basis on which you measure performance. So at the moment, our equity portfolios are measured relative to a benchmark, and the benchmark is the FTSE index. Now, the FTSE index is substantially dominated by oil companies and mining companies, none of which, it's fair to say, is terribly environmentally friendly. So, if you set a target that is based on an index that includes all that, you're inevitably going to have people, that's what you're going to have a fair chunk of that in your investment. Now, we can choose a different index. There are some indexes that have either structured so they have no oil and gas companies in them, or are low carbon in some other way. We're starting the discussions about which approach to take to reducing carbon in those portfolios. Now, this will take time. This is not something that will happen overnight, but if it's successful, it won't be £2.6 billion worth of equity assets that have been influenced. It will be 7 or 8. So the prize in terms of impact is far greater if we manage to exercise our influence on Border to Coast than it would be if we try simply to do things on our own, and we're not able anymore to do things on our own. Okay, I've no doubt there'll be other questions on that, so I'll move on to the next one. So, what plans are in place to provide lower carbon funds within Border to Coast. I've touched on that. Now we are seeking to try and influence them to do it. Someone asked about why don't you invest in the low carbon funds that BlackRock and Legal & General provide. The reason we don't do that is that those are what are called passive funds. So a passive fund just tracks the index. So your performance target for that fund is to match the index. And in those two cases, they match a low carbon index. So once you pay the fee, the return you get is less than the index. So let's say the fee is 5 basis points. 1% is 100 basis points. So let's say the fee is 5 basis points. So you're going to get whatever the index does, less 5 basis points. The mandates that we give Border to Coast are what are called active mandates, actively managed. So their target is to outperform the index by a given amount. And we'll be paying Border to Coast about 5 basis points. So if they get the target, which is 1% over the index, we'll get 0.95% of performance after the fee. So that's why we've not invested in those funds that are available, but we are going to work towards Border to Coast doing it. Will you publish the carbon audit of the investment? We've published what we can publish already. It's with the papers for the investment board on the website. It's also with the investment strategies and policies on the main sypensions.org.uk website. We cannot publish the whole detailed report because the contract we have with the provider doesn't allow us to. That's the only way on which we could get the carbon audit undertaken, but we have made public as much information as we can. What protections are in place to ensure that pensions are not lost, as happened with the BHS pensioners? It's a very good question, but one that, in a sense, is quite difficult to answer because we operate in a very different regulatory environment to a private company's pension scheme. Ultimately, should everything really go Pete-Tong, then the payment of pensions is a charge on the revenues of the 4 district councils, at which point I'm going to run out the room and hope the councillors aren't chasing me out, given the scale of the budget challenges that the 4 councils face. That isn't going to happen because of the framework of controls we've got, which is part of what I talked about when I was talking about probity, that mean that we cannot do silly things. We cannot, and there's no practical way anyway, of the councils taking money out of the pension fund in the way that companies have done in the past. Maxwell did and others. We're not subject to the pension protection fund that is the so-called lifeboat fund for private sector pension funds, but we're not subject to that because we're a public sector scheme. So I was, when thinking about how to answer this, I was struggling to conceive of a situation where action could be taken in the way that BHS, Carillion or Maxwell took action to plunder a pension scheme. And I just can't come up with a situation where that would be done because there are all sorts of controls in place that prevent it happening. So this is more interesting. There's a lot of housing needed. What are we going to do about supporting housing, particularly housing locally? Well, as I said earlier, we already invest in a number of social housing funds. The reference to one of the funds that's implied in the question is a fund that we're actually already invested in. We have just agreed a £25 million investment in a housing fund targeting Yorkshire. We're putting in 25 million, West Yorkshire are putting in 25 million. That's an extension to a fund that invested in commercial property that both of us already invest in. We are looking at a residential property fund that is targeting the top right-hand corner of England as you look at it on the map. So north of the Humber up to the Scottish border. It's very difficult to. This is not something we would do ourselves. We wouldn't go along and find a developer and say, you know, here's 50 million quid, go and build a load of houses. We need to do this through fund managers. Fund managers, unfortunately, won't build a fund that's South Yorkshire on its own. So we've got to look at what's available in the market, but we do look at what's available, and as I've said, we're working on those two at the moment. One's agreed, one's about to go into due diligence, and we're also on a related but not sort of housing front in terms of sort of, you know, there's a fairly legitimate question about, well, why are none of the commercial properties that the fund owns in South Yorkshire? And I wish someone had asked it, because it would have given me the opportunity to give this answer. They aren't. Not because there aren't viable properties, it's just the property manager hasn't found any. But we are going to make a substantial investment in a fund, a Sheffield City Region fund that's managed by CBRE. It was seeded originally with European money. It's called the Jessica Fund. But that invests in commercial property across South Yorkshire and the City Region. So we'll be investing in that alongside the City Region and Dan Jarvis's combined authority. So we're not unaware of the investment needs of the place that we serve, but our first duty must be to make the return that pays pensions. So whatever transactions that fund does will be genuinely commercial transactions. Okay, so thank you for coming. I know there's going to be some other questions, so Joanne and Karen are wandering around. So one of yeah, we'll get you the microphone. Hang on. Yeah.
Last time I was here, or the time before, the fund had got a deficit. Now the fund hasn't got a deficit, want a better expression. Has the criteria for the funding, whatever the word is for it, changed in the last 2 or 3 years or not? Yes or no, really?
Yeah, no.
Fine.
No, we had a couple of very, very good years.
Yeah, that's fine. Thank you very much.
Yeah.
Have you lost flexibility regarding investments since cost to...
Yeah, so has pooling given us a loss of flexibility? To some degree, yes. And that was always going to be the case. Well, it's always the case if you use an external manager. Okay? So when we were running our own money for ourselves, we're only accountable to ourselves. Yeah? So if we wanted to run a portfolio that strayed massively from the benchmark, we were able to do that. Border to Coast aren't able to do that because they're a regulated entity. They have to publish a prospectus that says this UK portfolio that you're investing in has a performance target of this, and then these other statistical factors that flow from that, things that are called tracking error and Sharpe ratio and things like that. Those are statistical calculations that have to be kept within certain limits, and they're allowed to take positions that are no more than X% away from the benchmark in either direction. So they are much more limited. They're much more prescribed than we were. You know, we didn't set limits about how much on or off, you know, how close to the benchmark we had to be. We could take significant off benchmark positions, and sometimes did. We're running our own money. That's our own risk. Border to coast are running on other people's money. People invest in a fund in part based on the level of investment risk that fund takes. So a fund that targets the benchmark plus 1% takes less risk than a fund that targets the benchmark plus 3 or 4%. So yes, we've lost some of that flexibility. We also, to achieve some of our wider objectives, need to go through much more negotiation than we ever had to previously. You know, if before July we'd wanted to significantly support renewable energy within one of the portfolios, we could have said to the investment team, right, go and buy a load of renewable energy, don't stop until you've spent this much. Much more difficult in the context we're operating in now. So the answer is broadly yes, but there are good reasons why it's yes. And those reasons are intended to protect us as a customer rather than to limit us. But we are investing in a very different way to the way in which this authority has been used to. Any more? Is there one more at the
It just follows the first question the chap over there asked, that if there is a deficit, you can call on the 4 principal authorities in South Yorkshire, and if I'm right, they can't refuse. They've got to. And if I may, just a quick second question: who is the monitoring officer?
The monitoring officer is Andrew Frosdick, who's the monitoring officer of Barnsley Met. The circumstances when pensions would be a charge on the revenues of the districts is effectively if there's no money in the fund. So we'd have taken action long before it got to that stage, hopefully. Any more? Okay, thank you very much. Thank you for your attendance and your attention and your questions.
Just before the chair of the authority closes the session, because I can hear the buffet being put out as we speak. I'll be super quick with this point, but if you just bear with me for a second. When I was talking to you earlier about the problems that we'd had with our IT systems over the last few years, and Gary's been talking to you previous years about all of those systems that we've now got to a much better place in. The poor person that had to manage those systems over the last few years is somebody that's here with us today. She doesn't look old enough, but she's actually leaving us for Pastures New after 27 years service in the next month. So if you don't mind, I just wanted to take this opportunity publicly to thank Karen. Hopefully she'll stand up, and Barrister, for everything that she's done. So if you wouldn't mind giving a round of applause.